any big liquid asset is going to have ETFs. I don't really look at it in terms of Bitcoin price. I mean, the unit numbers are arbitrary. The decimal point could have been somewhere else. And instead, it's more of like, what is the network worth, right? So the fact that it's only like $1 trillion and change right now for market cap, I think is tiny compared to what it could be worth in 10, 20, 30 years. So the question is that I ask myself is there anything that would just derail this? What is the probability that something replaces it or breaks it or otherwise just it doesn't work? And if none of those things happen, then I think the network value is likely far north of here in 10, 20 plus years. And stablecoins are just kind of the latest iteration of Eurodollars. And there's a demand for it. And it's like offshore banking for the middle class, right? Because it kind of reduces the overhead of someone in Argentina or Egypt or Lebanon accessing dollars if they want that for whatever purposes they might want that.
Alden notes that volatility and technological uncertainty remain significant barriers to adoption by institutions like sovereign wealth funds. Bitcoin, being a relatively young asset class at 15 to 16 years old, needs more time to mature and develop liquidity before becoming attractive to these larger pools of capital. She explains that only once Bitcoin reaches higher levels of market cap and liquidity will it catch the attention of major investors like BlackRock and sovereign funds. Alden stresses that Bitcoin's dollar-denominated price is arbitrary. Instead, what matters is the network's intrinsic value. Assuming no catastrophic disruption to Bitcoin's protocol or competitive replacement, she believes that the network's market cap could grow substantially, potentially reaching high six-figure prices per coin over the next 2 decades.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
The total addressable market of good money is arguably the biggest or second biggest market out there along with real estate, right? So, if you look at there's 900 trillion in estimated assets in the world. And so we're like less than 1% for Bitcoin. Even gold at something like 20 trillion now is tiny compared to global assets. Some of the areas that are shockingly big are fiat currencies and bonds. I mean, there are hundreds of trillions of dollars of value. And I think a lot of that is better served in Bitcoin. And just people, it's obviously got high volatility, which keeps people out. It's got technological uncertainty. I mean, it's a 15, 16-year-old project. So, nation states don't put their $1 trillion sovereign wealth fund aggressively into it until maybe it's 30 years old and it's 10 times bigger, right? So I think, and the way that I've described this before is that it has to reach certain thresholds before it even becomes interesting to higher thresholds. So back when the market cap was like $1 billion and it was pretty illiquid and literally one wealthy person could just buy in that day and move the price, that's not interesting to sovereign wealth funds or BlackRock or billionaires, because it's too small and illiquid for them to even put a significant amount of their capital into it. But then when it starts to become bigger, and they can say, well, I can actually layer into this asset at a meaningful amount for me, and there's a I can be fairly certain that I'd be able to sell if I needed to because the liquidity would be there. And then higher level, then even bigger pools of capital can say, hey, this is actually, worthwhile being on our radar now. And so I think I don't really look at it in terms of Bitcoin price. I mean, the unit numbers are arbitrary. The decimal point could have been somewhere else. And instead, it's more of like, what is the network worth? Right. So the fact that it's only like $1 trillion and change right now for market cap, I think is tiny compared to what it could be worth in 10, 20, 30 years. So the question is that I ask myself is there anything that would just derail this? What is the probability that something replaces it or breaks it or otherwise just it doesn't work? And if none of those things happen, then I think the network value is likely far north of here in 10, 20 plus years. I mean, I would like to see it in the high six figures per coin by then. There are certain decision points that can just change everything, right? So I mean, if we do get a president that wants to like make a Bitcoin reserve, however unlikely that is, if that actually happens, then the world where that happens in a given 8-year period is very different than the world where instead the U.S. gets enough alignment to try to like really go hard after Bitcoin and like hurt it as much as possible, right? So I don't really have like a firm price target. I think that the two things I'm fairly high conviction on are higher highs and higher lows in that 8-year period, and that I expect it to still continue to be pretty correlated with measures of global liquidity. I actually have a research report coming out later today. It'll be out by the time this airs, that measures Bitcoin's correlation with global liquidity and how it correlates better than other asset classes to global liquidity. And so basically, I expect most likely that pattern to continue hold probably over the next 2 cycles. Doesn't mean it holds 100% of the time, but it that general correlation is pretty strong. And so during periods where liquidity is more constrained, I would expect to see Bitcoin struggle to some extent. It could be a bear market or it could be a sideways market. And when liquidity is pretty good, I generally think Bitcoin's probably going to do pretty well with it. I've been bullish on stablecoins for a while. The broader topic is just any like real world assets, right? So it could be tokenized gold, it could be tokenized T-bills, tokenized dollars. That's what a stablecoin is. Basically, there's, in financial history, there's always been Eurodollars, which is dollars that exist outside of the U.S. banking environment, not just in Europe, but elsewhere, even though they're called Eurodollars. And stablecoins are just kind of the latest iteration of Eurodollars. And there's a demand for it, and it's like offshore banking for the middle class, right? Because it kind of reduces the overhead of someone in Argentina or Egypt or Lebanon accessing dollars if they want that for whatever purposes they might want that. So I think stablecoins and networks that run stablecoins have relevance for probably quite a while. When Salvador wants to issue debt to have a hotel built, and they don't really have domestic capital markets, and then they put it on either layer on top of Bitcoin, or even they put it elsewhere. I can see value in that. There's been interesting research. Like there are programmers on other networks that have they've pushed forward the computer science of rollups and things like that eventually can find their way to Bitcoin in some capacity. So I think that it's partly going through this iterative process to see what works. There's a lot of scams there, obviously, but the short answer is that outside of Bitcoin and stablecoins and these little kind of research niches, I've been publicly skeptical on the value of most of that other stuff.
While some critics argue that ETF concentrate Bitcoin ownership among a few custodians, Alden believes that the risk is overstated. She notes that ETFs such as Grayscale's GBTC previously held over 600,000 Bitcoin, demonstrating that large holdings within ETF are not a new phenomenon. Instead, she sees ETF as an inevitable feature of Bitcoin's integration into the traditional financial system. Driven by institutions like BlackRock and regulators like the SEC, Alden describes ETF as an API into the fiat system, a way for Bitcoin to plug into the existing financial infrastructure. This integration is not something Bitcoin chose, but rather a decision made by legacy financial players to accommodate the growing demand for digital assets.
Any big liquid asset is going to have ETFs. So if Bitcoin can't deal with ETFs, it wasn't even worth owning for the past 15 years, right? Now, you still have to think, okay, is Bitcoin good enough in a place, technologically speaking, that that holding it yourself is workable and attractive compared to letting someone else hold it for you? And if not, then what can be done to keep improving that in various ways? I mean, that's why I do Bitcoin Venture. I'm a general partner at Ego Death Capital, so we're literally funding companies that are trying to improve the ecosystem in some way. But I think ETFs are inevitable. I think they're pools of capital, especially in retirement accounts that literally don't have another way to get in. This is they have a existing brokerage, and they want to be able to buy an asset, and they don't want to hold the keys. And I think that not everybody wants to hold the keys, kind of like how not everybody wants to fix their own car. Not everyone wants to, be a handyman around their house. And some people just don't really want to hold. They don't really want that sovereign property. And I think it's something worth monitoring. And then also, like, GBTC existed for years as a adjacent to an ETF, and it got over 600,000 Bitcoin in it at one point. And so a lot of this current ETF accumulation is just money flowing out of that and into other ETFs, which are still ultimately mostly at Coinbase. And so I think that there's risk of concentration, but it's not as big as people think, because like, it's not that much more coins in these things than there were 3 years ago when it was just GBTC. So I just think it's inevitable. It's pools of capital are going to do that. I've described this as like an API into the fiat system. People have these existing brokerages, and this was like an upgrade that the fiat currency system decided to make to plug into Bitcoin. It's not something that Bitcoin decided. It's something that the BlackRocks and the SECs of the world decided, and so they opened their system to plug into Bitcoin a little bit more than they did a year ago. You have rising new technology, new ecosystems, new enthusiasm, and the technology is generally better than it was any given 5-year period ago. And so I think basically what you can do, depending on what level you're at, is just you can opt out, or at least you can have a foot in both worlds. You can say, I'll use the incumbent system for when I have to, and for kind of local, most people have a bank account and they use it, but I'm going to kind of take that side with a grain of salt because it's only going in one weakening direction, and I'm going to embrace this newer thing, which is Bitcoin, or in some countries also stablecoins, but basically really the two applications of this technology that have had really good product market fit, and say I'm going to go into this world instead, and I'm going to store my value in something that isn't diluted by any sort of central entity. And I think and then if you're a corporation or a government, you can do similar. Generally speaking, the smaller the entity, the fewer decision makers, and the larger the entity, the more decision makers, with some exceptions. And you just kind of opt out, and you protect yourself. And I think there's a very long process of more and more people doing it. And then along the way, what we're doing is we're testing this new system. We're saying, how secure is it really? How robust is it really? What needs to be improved about it, either on, say, the base layer or the various layers that click on top of it and enhance it. How can we make this better and truly replace as many components as possible of the prior entropic system.
Alden advises individuals and corporations to hedge against the depreciation of fiat currencies by embracing Bitcoin and stablecoins. While most people will continue to use traditional banking systems out of necessity, she recommends adopting a foot-in-both-worlds approach. This means using fiat for day-to-day transactions, but storing long-term value in Bitcoin or other decentralized assets that are not subject to inflation or central control. Alden suggests that smaller entities with fewer decision-makers can more easily adopt Bitcoin strategies, while larger organizations may take longer to pivot due to their bureaucratic structures. As more entities experiment with Bitcoin, they are stress testing the system's robustness and security, identifying areas for improvement along the way.
Please like and subscribe my channel.